I'm a techno-functional consultant with almost 5+ years of experience in various implementation activities. I have implementation experience in enterprise planning and budgeting, along with some one of the project on EPRCS, along with the functional knowledge of the modules such as financial, workforce, capex, and project module. Today, we would be discussing a small functional concept under project module related to capital budgeting. Okay, now beginning with this particular webinar, what we would be doing today is we would discuss the concept, and then what we will do, we will have a small uh, live demo of the same in application, and then we will validate the same in Excel how the calculations takes place. Okay, so starting up with what is the definition of capital budgeting. So the capital budgeting is the process that companies use for making long term investment decisions. So what does it mean? Say an organization has some requirement, future requirement, wherein they want to start up a new project. Now, what could be that new project? Example of capital budgeting project involves acquiring some new machinery, or it could be replacing a current machinery, or it could be launching a new product, or there could be project which requires spending on some research and development program. So what does acquiring new machinery involves? It involves what would be the cost of acquiring, what would be the cash flow that would be generated in near future based on that particular acquisition of new machinery. Okay. Apart from that, in case of replacement of current machinery, we take into account whether the replacement project that we are about to undertake, whether it is feasible for organization or not with regard to the net present value for that particular project. Okay, apart from that, there could be some new product launch that we are looking forward in near future. So what exactly is the cost associated with that particular project at the time of development of that particular new project, and what could be the potential cash inflows related to that particular project. Apart from that, we have certain projects which require internal research and development. Say you have some upcoming project wherein you have developed a new project, but you want to do some research and development with regard to consumer preference for that particular project. So some marketing related expenses or some research and development related expenses could be managed under project module re- with special focus on capital budgeting. Now, why capital budgeting, or what is the importance of capital budgeting? So whenever an organization is looking forward to do an investment in certain capital projects, a significant amount of capital is usually tied up in that long term projects, because most of these capital budgeting projects are long term for at least 3 to 5 or 6 years or more. Okay, the principle of capital budgeting can also be used in making other operating decisions such as investment in working capital or acquisition of other companies. Okay, so there could be decisions wherein organization is looking forward to do a big chunk of, or utilize a big chunk of their cash in introducing a new uh, project requiring building of land, so or building of a building or a capital asset, wherein there could be machineries involved, buying of machinery involves, there could be labor expenses, material expenses, and all other expenses which requires a lot of cash tied up. So it becomes important for an organization to do feasibility study about the project with regard to the benefit of the project, project profitability, and also other key indicators that we would be discussing. Okay, so what are the kind of capital budgeting projects that we have discussed? It could be a replacement project, it could be an extension project, It could be a new product and services. Then there is a kind of project which is regulatory, safety and environmental projects. So these projects does not bring in any cash inflows, but they are some regulatory norms required within an organization to implement certain projects. Say for a pharmaceutical company, it is required to have a water treatment plant established or upgradation of that particular water treatment plant. So this becomes a part of a project wherein capital is utilized, but there won't be any cash inflow. So what would be the effect of these kind of projects? So these could be studied under capital budgeting. Okay. Now there are some key indicators that are to be kept in mind while doing any kind of capital budgeting. So there are two most important measures that are used to evaluate any single capital project are first being net present value and then the second being internal rate of return. Now what does this net present value represent? For a project with one investment outflow, that is the cash required or the cash infused in the project which occurs at the beginning of the project, the net present value is the present value of future after tax cash flow minus the investment outflow. So what does it mean? Say an organization have a outflow of cash for buying a machinery required in one of its projects. So there would be a cash outflow, and based on that particular machinery that the organization buy, the same machinery would be utilized for certain manufacturing within an organization, which would result into an increased capacity of manufacturing and thus thereby resulting into inflow of cash. Now that inflow of cash and outflow of cash together constitute the net present value calculation. So in short, net present value measures the amount of monetary terms that a project is expected to add to a company's wealth. The basic formula or the formula for net present value is it's the cash after tax cash flow at time t divided by required rate of return, 1 minus required rate of return of investment and outlay. That is the initial cash outflow for the purpose of purchase of that particular machinery for that particular project. Now there are certain decision rules that are to be kept uh, while calculating any net present value. So net present value should always be greater than zero for a particular project to be considered as feasible. Okay. Net present value with negative value must not be undertaken. Any project that gives you a NPV of negative value should not be undertaken, and net present value of zero has no impact on wealth creation. So any project is considered feasible if it has a net present value greater than zero. Okay. The second major indicator or any project related decision is the internal rate of return. Now what is internal rate of return for a project with only one investment outflow which occurs at the beginning of project? Internal rate of return is the discount rate which makes the sum of present value of future cash flow equal to initial investment outlay. So in short, what it is the actual return that an organization gets from investment in any kind of project, depending on the cash outflows and cash inflows. And the decision rule for internal rate of return being internal rate of return should always be greater than the required rate of return. So say for an organization, they have a required rate of return as 10%. So for a particular project to be feasible, the internal rate of return should always be greater than that required rate of return. Now, they there are scenarios wherein we have replacement projects. So in that case, what happens? We have multiple projects which are mutually exclusive. Okay. So in that case, say we have two projects, both require buying of machinery and they both are mutually exclusive to each other. In that case, we do our analysis, we come across with the calculation of net present value and internal rate of return. Okay. And whenever we have a comparison of two mutually exclusive projects, okay, in that case we take into account only that project which have higher net present value in case both the projects gives us the same internal rate of return. So these are the basic concepts that we keep in mind, okay, while making any project related decision. Now, there is another KPI which is the payback period. Okay, so definition of payback period goes: a project's payback period equals the time it takes for the initial investment for the project to be recovered through after tax cash flow from the project. Now, what does it mean? Say we have investment 1 million in our current year, say in year 2020, and from this outflow of cash, we have certain inflow of cash in the coming future, near future, that is in the near 2 to 3 years. So say for the first year we have a inflow of cash against this 1 million as 50,000 and 60,000. Okay, so we get back our cash flow, the complete cash outflow as converted into cash inflow in the year 2. So our payback period becomes in this case 2. Now, there could be cases wherein cash inflows are on monthly basis. So what the system does, it calculates the cash flow on actual real time basis. Okay. Now, then there is one of the most important key indicator, that is benefit to cost ratio, that is to be kept in mind while undertaking any project feasibility study. Okay. So what is benefit cost ratio? So if a project has a BCR greater than 1, the project is expected to deliver a positive net present value to a firm and its investor. So BCR is calculated by dividing the proposed total cash benefits of a project by the proposed total cash cost of the project. Okay. Now, prior to dividing the number, the net present value of the respective cash flows over the proposed lifetime of the projects, taking into account the terminal value. So what does it mean? It basically means that whatever calculation is required to bring into account or to make the calculation of BCR, we have to take into account the net present value, and we have to calculate net present value of cash outflow, net present value of cash inflows, bring it to the terminal value, that is the taking into account the time value of money, and then we calculate the BCR. And a BCR of greater than 1 is considered good for any project. Then we have one more indicator as profitability index. Now, what does this mean? The profitability index of an investment equals to the present value of project's future cash flow. So it's just an indicator of whether the project is feasible or not. Okay. Now, this is what we have as a theory. But since we would be looking forward to have the same in our application, so say I have this Excel, a small uh, so we have this small case scenario that we would be discussing. So say we have a initial investment required for a capital project which would be requiring a cash outflow of 30 million. Okay, which generates after tax cash flow in year 1, 2 and 3 as 10 million, 40 million and 80 million. For this particular project, we have a required rate of return as 10%. And what we have to do, we have to determine NPV and IRR. So what we will do, we will take these particular scenario into our application, do the calculation, and then we will cross verify the same in Excel, how the calculations takes place. Okay. So for that, what we do, we just enable our project module, and under project module, what we do, we just add a new project with the information as we have in our case scenario. Okay. So what we do, let's just add one project. Okay. So what does let me name the project as project one. Okay. Description being optional, my project would be starting next year Jan. Okay. And the since we have three cash flows, so it will mm, our project end date will be 3 years from current date. Okay, so 22, 23 and 24 December being the end of our project. Okay, so we would be discussing this particular scenario within our application, and then we will do the same calculation in our Excel sheet. Okay, so we have this project one in here. Okay, I have two projects in here with the same name. Let me just delete one of the project, or will get confused. Project one get okay. Okay, so no more project. Let me add with a new name instead of project one. Okay, okay. The date of project would be starting from 1st Jan, ending December 3 years from now. So 20, okay. So 31st, 23rd being our end date for this particular project. So we have a same project name, project. Okay, so once the system adds the project, we have some options that we could provide with. So say for this particular project, we have a priority, we could set a priority high, medium, low accordingly, and we could rank the project. So it is just the description, justification for this project, not mandatory, optional. Okay. So after we add project, we need to provide with the expenses that are related to this project. So there is a expense related to buying of this project, which requires cash outflow of 30 million. Okay. So let's just add this expense amount. So when we add this amount, the system will calculate the expenses. Okay. So what is the kind of expense that we are taking into account? Let me just select the project first. So we have our internal project. Under capital project, we are taking into account project A. And for this particular project, we have a expense. Okay. The project date should be actually 24, not 23. Say we have the outlay in 2021, then 2022, 2023, and 2024. Okay, so the period should go till 2024. Let me just change this period. December 24. Okay. Since we made some changes, let me just refresh project dates. Okay. Whenever we have any change, we have to refresh the project dates. Okay. Now let just provide with the expense that would be incurred. Okay. So say for this particular project, we have a cash outflow of 30 million. So let me just add this amount. So the project being involving cash outflow at the very beginning of the year. So let me just provide with the cash outflow of 30 million. Okay. And we provide with the type of expense, the line item. So it's an equipment expense. Let's say it's an equipment expense that we would be incurring for this particular project. Okay. Once you provide with the data, you just calculate expense and the system will calculate the expense pertaining to this particular project. Okay. Let me do the same thing in here. We have a cash outflow of 30 million. So 30 million being a cash outflow, and since it's an outflow, let me just keep it as negative value because the Excel will calculate then the present value as negative if I don't keep outflow as negative. Okay. Then what we have project financial benefits. Okay. So what are project financial benefits? We have a project financial benefit of 10 million in first year. Then we have a project benefit of 40 million, sorry, 14 million in year two. Sorry. And then we have a cash inflow of 18 million in year three. Okay. So these being our cash inflows, let me just copy this amount. Okay. So our cash flow inflow starting from year two, we just provide with the amount in here, cash inflow. Okay. And year two, we have our cash inflow is 40. And for year 24, we have a cash inflow as 18 million. Okay, just saved the data pertaining to the cash inflows for this particular project. And what we do, we calculate project benefits. We go to business rule and we just do a calculation for this particular project. What the system will do, it will calculate the expenses related to this particular project and the cash inflows for this project. Okay, so let me just calculate the present value in here first. Okay, so I have this solved example. I have just solved this in here. So what it takes, I have this formula in here. Let me just use these in this particular. Okay, so we have our present value calculation inbuilt function in Excel PV. It says you need to provide rate. Okay, let me just provide the rate as 10%, the required rate of return. Okay, so my present value for first cash outflow rate this, and the cash inflow that I have this, and I don't have any future value and all. Okay, this is what it does, is it just calculates the present value of cash inflow for year one. Okay, again let me just calculate the present value for cash out inflow for year two. For second year we have inflow of 14 million. Okay, and for third year we have a inflow of cash as 18 billion. Okay, so our net present value is sum of all these and the initial cash outflow. So since I just took negative amount, let me just trace it as. So this is what would be our, we will get as, this is the amount that we should get in our application also, the calculation of NPV. Okay, now if I just go to project summary, we have we should have these particular calculations. Okay, so what, okay, there's one thing that I need to do. I need to provide with the project capitalization. Okay, so say for this particular project comes under equipment expense, and we have a capital expense as acquisition cost. We provide with the capitalization percentage. So what it will do, it will uh, take into account the amount invested, and the percentage amount that we provide will be taken up as asset for the organization. Okay, so say we are taking into account 100% capitalization for this particular project, keeping up the asset class as machinery and equipment, and we provide with a capital work in progress and asset detail. Okay, just save this, and what it will do, it will calculate the expenses, and then it will provide with the capitalized amount within the application. Okay, once done, what we'll do, we'll also calculate the depreciation associated with this particular project for the purpose of taking into account what would be the depreciation cost and what will be the basic asset value. Okay, so since we took 100% and we have a outflow of 3 lakh for that particular project that we would be uh, studying. Okay, so it takes the complete value. Now to calculate the depreciation, we need to provide with the in service date, and since we would be having a project starting from 1st of Jan 2021, we provide with the in-service date and we provide with the depreciation method. Okay, so for this particular project, I'm just taking into account depreciation method as straight line and depreciation convention being the pro rata begin period. Okay, once done, just save, and once saved, we'll just do the calculation of depreciation. And what it will do, the system will take into account the assumptions and do the calculation and provide with the depreciation expense. Okay, if you just go to capital project overview, I need to just do one okay, so I didn't do the calculate expense calculation. Let me just again run this rule. Okay. So once done, okay. So what we are missing, we haven't provided with these assumptions. So these are our discount rate assumptions that we need to provide to the application. So 10% being our assumptions. And let me just calculate project. Okay. So once we calculate project, all the calculation will be taken care of for this particular project. My input currency being USD. Just launch. It takes into account the calculations for net present value and the ratios that are required. So what the system will do, it will calculate the net present value. It will provide you with the total investment amount, to total cash inflows and all. Okay, so so there is one thing that is missing. The project benefits, the system is not okay. I haven't provided with the assumption of what kind of benefits that we are taking into account. So say for this particular project, we will be providing with some service revenue. So let me take into account the impacted account. So since we didn't take into account the impacted account, so the application was not calculating the cash benefits associated. Once done, let me just again run this particular benefit rule. Okay, so we have a present value calculated, we have a project benefit being calculated, the project cash flow calculated. Okay, so we have the same net present value amount. Okay, for okay, I just took some different amount in here, so it is giving me a different calculation. Okay, let me just put a negative value minus sign so that I will get the correct sum in here. Okay, so the system is calculating it differently because what we do in system is we provide with the actual amount and what is happening in here. Okay, so let me just check what is the difference. Okay, the thing is I am doing the right calculations. So what's, let me just check in here. Okay, so what it did, I did a mistake. I, instead of using future value, I should have used PMT as 0 and I should have provided with the future value. So let me just correct this formula in here. Let me just recalculate it again. Okay, because present value providing with the rate, period, there is no part payment, and this is what we have as our future value. Okay, and let me just remove this negative sign from here. Okay, so for second year, again rate being same, period being second, no part payment, and my future value of cash inflow being 14. Okay, and I'm missing a negative sign again, and then for year 3, rate, period, no part payment, and my future value. Okay, and a negative values to be assigned in here. Okay, so we are getting the same number in here, 4184823, 4184823. Okay, so this is how the calculations are taken care by application. Now what is this? We have to do a lot of calculations since we have very limited data, so it was easy for us to do the calculation on Excel. But say we have a condition wherein multiple cash inflows are required, so the detailing of the cash inflows could be, since we just provided a direct inflow input of cash flow as 10 million here, it could be a different way wherein we could have provided cash inflows on quarterly basis. It could be on monthly basis. Then it becomes a very uh, large set of data that is required to be calculated, and then to calculate the same on Excel becomes difficult. Okay, so this is how any project related feasibility study could be done. Okay, now let's take into account one more example wherein we are required to have a study of replacement. So we have a scenario, company is considering to do a replacement of its existing machine. Okay, so what they should do, they should buy machine which is similar to existing machine. So say machine A is similar to existing machine, or they should buy a more expensive machine which have a higher inflow of cash. Okay, so this is how we could do a comparative study. So to do the same, what we have to do, we again have to create two project being machine A, machine B, providing it with the details, and we could find out the feasibility of that particular project. So say machine A, okay, and the period being it is for 5 years. Okay, so my project starting next year, and for 5 years, ending 31st, I just launched this particular project. So project gets added up, and then we provide with the expenses related to this particular project. Okay, so going into expense, we'll do all the same calculations. We have to provide with the same all the same calculations for this particular project. Okay, so taking into account that particular machine A, and this time I would be a bit quick since we have a limited time for this particular session. So machine A, we have this particular project in here, the same equipment cost we will take into account, same thing, equipment cost. Okay, and we provide with the amount that outflow amount, so it's 25 million. So let me just provide with the outflow amount, so 25 million. Okay, just save your data. The system will do the calculation of expenses accordingly. I provide with the project financial benefits. So say again for this particular account, we have the impacted account again being service revenue. We have a cash inflow for year one. There is no cash inflow. For year two, we have 5, 6. Okay. For year three, we have 20. Okay. And for year four, we have 14. Okay. I just took only 3 years. So we will do the calculation till this particular. Okay, let me just delete this column and we'll do the calculations accordingly. Okay, just save this. The system is taking time. Okay, once done, we go again move to project summary. Just calculate project. Okay, what is the currency type? And the system will calculate the net present value and BCR accordingly. Okay, so the same information that we provide in our project module get you could just push that particular information all to your capital module also. Okay, so machine 8 just calculated return on investment, the net present value, the benefit, and if we go to capital project variance, it provides with the benefit cost ratio and all other things. Okay, now let me just push this data from project to our module, that is our capital module. So let me just again select that project A. Okay, and let me just push this particular. We have a business rule in here which allows us to push data to capex from project. Okay, so we could have the impact study of the same in a capital module with regard to the cost of the machinery, the depreciation expense, and if you provide with other capital related expenses such as repair, maintenance, and all. Okay, so if I just move to capital module, we could see that same expenses being reflected under investment under capital work in progress. Okay, so for this particular project A, we have this total expense for this particular machinery being calculated. If I just go to detail analysis, it will provide you with all the information for the balance sheet with regard to the expenses being incurred. Okay, so this is how it takes care of all the calculations within the application. Some of the dashboard won't reflect because they require at least 2 years of data comparison for both the actuals and the plan. So sometime it won't work, and we need to provide all the data for rendering all the dashboard. But yes, we will have the project related summary in here. So this is what capital asset 1 has the value, for capital asset 2 will have the same values in here. So we'll have the study in here and analysis. Okay, and the same analysis could be viewed in your project module also, and it provides you with the cash inflows and cash outflows complete analysis of the same. So we just move to card, the analysis card. Okay, for this project A, we have a cash inflows study in here. So what it says, we have a cash outflow of 30 million, so it provided with the projected cash outflow. Then we have this projected cash inflows, and what exactly is the cash in that the organization would retain for this particular project. So a detailed analysis of all could be we could have in within our application. Okay, so this is how we could do the feasibility study of any project, any capital related project within our application, being real time and on the fly, and all the calculations gets calculated on the fly. Nothing is to be managed by the user. User only have to provide with its data pertaining to any project that they are interested in the near future, and then the system calculates all the numbers by default. Okay, then we could have other scenarios such as project sensitivity analysis, wherein we have certain uh, as I have discussed, a new product development which required an initial investment, and there was some inflows. That inflows were in the form of per unit cost. So all these calculations could be taken care in within our application. Okay, so we would be discussing this particular scenario in upcoming webinar, the capital budgeting webinar 2. Okay, and this is how we take care of project planning pertaining or specifically for capital project. Okay, now if anyone have any question, just ask me. I'm open for any of the questions, and I have one question being posted by Henny, and he says, does this concept apply to government projects also? And it's not. Yes, these projects apply to government projects also, because there are certain government projects wherein only cash outflow are there. There is no benefits associated. Say there are some CSR activities which require certain projects to be carried out. Okay, so in that case what will happen, we will only have cash outflow, there won't be any cash inflow. So yes, you could have that particular kind of feasibility study also in our application. Any other question from any one of you? Any conceptual question or the functional question with regard to what this NPV is, and what this BCR, how the ROI gets calculated? Any question regarding to how the configuration takes place? I am open to any kind of questions. Okay. Okay, so it seems that we don't have any questions. So if you have any questions coming up in your mind with regard to this particular session, you could just provide a mail of the same to Mohit, and he will forward me the same, and we would be really happy to answer all your queries on mail. Okay, thank you for your time. This is all that we have today for this particular webinar.